All right, welcome everyone. Welcome to the trade finance adjustments for Tuesday night, the 24th of March. We're going to create a short class on leap long calls. I know we kind of did something similar to this here probably a month ago, but I want to go a little bit more in depth so that you understand what a leap long call is and the advantages. If I was to ask you, what is a long call? The definition, the rights and responsibilities, what would you tell me? What would you tell me the definition of a long call is? I'm going to say buy to open, right? BTO. If you're buying it, it's a right. You're not obligated. You have the right to buy the stock at a certain price for a certain period of time. That is the long calls, buy to open, is the right to buy the stock at a certain price for a certain period of time. That certain price is called a strike price. And that certain period of time is until the expiration. So, the idea makes money when the stock trades / moves bullish. It's an upward or a bullish moving position. Now, you've heard me say this in the past, and I'm going to reference it one more time. It is a stock replacement strategy. That's what it is. It's a way to replace stock ownership to leverage your money and doing a stock replacement strategy. Now, the benefits. Leaps are a type of option contract. The expiration date's longer than 1 year. So the main benefits are, number one, the ability to use less capital when compared to owning the actual stock. So if we were going to do a leap really quickly, give me a couple stocks you'd like to do a leap purchase on so I can go over the hedging of the position. First one that comes up, there we go, Apple. I can't think that's funny. I could have bet that's what was going to happen. Apple is the one we'll use, but we can also do a couple more to look at them. All right, give me a quick second here. All right, let's look to trade Apple. We're going to go out and we're going to pick the leap position. We can do a January 23. We can do a June 23. So I'm going out as far out in time as I possibly can. Notice when we look at the strike prices, April's only 21 days. We got to a January 23, we're 668 days. The stock and extended hours is trading at $122.45. If we were to purchase this stock after hours, our risk is $122.45. Every penny is at risk. So If we're to take a look at Apple, you typically want to try to see if you can save a little bit. We did 125, it cost $21.50. If we went $5 higher in strike, it would save us $1.80. Is it worth saving $1.80 to have the stock move $5 more? Those numbers don't add up for me. Those aren't going to be helpful. If I look at the deltas, a 125 gives me 58.5 cents versus 55 cents. I'll make 3 more pennies per dollar by spending $1.80 more. If I was going to do a leap long call, I would purchase it for $20.95. I'm even going to go up to 21. Let's say it takes us $21 to buy it. Let's do our understanding of the math. Apple currently trading at $122.45, which every penny is at risk. Now, will Apple go down to 0? Probably not. But that doesn't mean that every penny is not at risk. That doesn't mean that you couldn't lose half your money in Apple. Apple could definitely go down to $61 a share. If you use the leap long call for $21 cost basis, every penny is also at risk. But let's do the math. Would you rather lose $122.45 or $21? Which would be the loss acceptable for you guys? And it's kind of a no-brainer, right? Would you rather lose $122 or 21? Answer 21, right? $21 divided by 122.45 tells you a percentage of what's at risk. $21 divided by 122.45 equals 17.14% of the value of the stock is at risk. You can only lose 21 bucks. Apple gets down to $100, the most you lose is $21. Apple gets down to 50 with stock ownership, you could obviously lose $72.45. If the $21 is only 17.14% of the value of the stock, you've hedged, and it's really simple, right? You've hedged 82.85% of the risk of owning stock. Kevin, how did you come up with that? Well, it's really pretty simple. You're not buying the stock for $122. You are buying a stock replacement strategy. That stock replacement strategy is only worth 17.14% of the value of the stock. That's when you guys have heard me say, hey, if we can get called out on a collar trade, if we can take profits the first quarter, I'm going to take a third of those profits in the stock, which is going to be in that 15 to 17% range, and convert it to an option. We're going to take a lot less risk to make a higher percentage return. This is a fabulous way to hedge some risk and to boost returns in your portfolio. Now, I always get this question. So why don't you run the whole portfolio just using options? And the reason why is because if you were to protect this option, it would probably cost you about $9. Meaning if the stock moves up, you could lose every penny of that $9. That $9 is worth more than, it's almost worth half of the cost of the leap long call. It is not worth it. Mathematically, it's better to dollar cost average than to protect a stock replacement strategy. So that is why we don't do it. Now, occasionally, we're going to run into a problem. We're going to run into a problem where right here, why is it not working for me? I'm really looking for this. It's not going to work. We run into a problem where you have a Baidu leap long call at $3,350. It goes out to January 20 of 2023. So on the 20th of January 2023, your leap long call of $350 expires. If you notice, the change yesterday was $71.50. We had a problem with E-Trade and 4 different leap positions were not correct. It actually happened across the board for us. Big losses, huge losses. And we're working on getting these resolved. What happened is the feed wasn't coming across. Now, my question to them is, I tried to sell some leap long calls. When they were worth this ridiculous $110.77. When this was $71 higher, I went after it. And we couldn't get them sold. I'm probably not going to win my battle with E-Trade. Just because it says it's worth that doesn't mean that it is. Just because there's a problem with the feed, they've got the disclaimers, they're covered. But my problem is, if the cost basis was 110 and you add $71.50 to this, it should have been trading at 120. Why couldn't I sell it? I was trying to shut the whole thing down. I wanted to make $53 here. I wanted to make $10 here. $60 on a $110 purchase. Piece of cake. It was as if it was restricted. Kevin, is this because Baidu is doing a dual registration? No, companies do dual registrations all the time. The feed was messed up. Kevin, did you really lose $7,345? I did not. It was not up that high. So this loss did not come across the way it was supposed to. But I'm backdating and checking to make sure that we're taken care of. Which brings me to my third and final opportunity to show you something tonight. I am going to suggest that anytime you get something in the mail that looks like this, turning $500 into $58,636, while safely trading top companies in the world like Exxon, Verizon, Nike, Starbucks, and more. And we're all going, God, Exxon fell like a rock. Verizon did pretty crappy. Nike's returned. Starbucks hasn't really moved. It's been pretty flat. The first thing you should be thinking is scam. They're full of crap. Having a rare opportunity to potentially grow your portfolio 100 times this year and become wealthier than you ever dreamed possible. Six-figure risk-free system. And as you go through about it, you find out it's some Rob Rory guy. Tradewinds, six-figure system. I mean, Tradewinds is an absolute joke. Save $100 because you know what? This is so great. 80% winning trades means that 20% of our trades may not make money. Tell me if you guys can hear me. Just lost my audio, but it looks like it came back. Am I here? Am I back? Yep, I'm okay. All right. So Tradewinds, ridiculous. So I started to go through, and we have a pretty neat rare opportunity to see the growth. And here you've got Wells Fargo in 10 days and a put, and it made a 200% return. And, you know, 3 contracts, and it shows all these gains. I mean, you're just like, oh, killer. Oh, little loss. That sucks. Oh, killer. Oh, $35. Oh, 202. I mean, you're going through this for pages. They have pages of this bullshit. And then you come down here and you get some ridiculous, you know, 27 losses, 10 wins, 67,000, subtract the 4 for losses, you know, largest win, largest loss, and you're like, wow, amazing. Absolutely amazing. But you've got to look at what's being printed. Kevin, what do you mean? We're going to start on the fine print after 8 pages of this crap. Some profit examples are based on hypothetical or simulated trading. This means the trades are not actual trades and instead are hypothetical trades based on real market prices at the time the recommendations is disseminated. No actual money is invested, nor are any trades executed. Hypothetical or simulated performance is not necessarily indicative of future results. Hypothetical performance results have been inherent limitations, some of which are described below. Also, the hypothetical results do not include the costs of subscriptions, commissions, or fees. Because the trade's underlying examples have not actually been executed, the results may understate or overstate the impact of certain market factors, such as lack of liquidity. As you go through these, probably about a third of them would never have been filled. Simulated trading services in general are designed with the benefit of hindsight. No shit. Hey, I think it's going to go up because I can see that. So if I back test my model with a bullish trade on something that's going to go up, I'm going to win, which may not be relevant to actual trading. Shocker! If you have the hindsight of knowing where the stock's going to go, that means it might not be relevant to actual trading. No kidding. In addition, hypothetical trading does not involve financial risk. There's no worry, there's no fear, there's no greed. And no hypothetical trading record can completely account for the impact of financial risk of actually trading. ISS Publishing LLC makes no representation of warranties or any account will or is likely to achieve profits similar to those shown. What a crock of crap this place is. And in all honesty, they all are. If you are here with us tonight, there is no reason you ever need to spend money looking at any of the stuff that's online. Education is just that. It's education. It's hypothetical BS. You should be paper trading. You should be learning the strategies. You reset your portfolio every time you make a portfolio, you blow it up, and you start over. Trade advisories are not real. Education is not real. If I can impose anything in your mind tonight, don't waste your money on buying this crap when most of you, if you have gone through an education, know more than the joker that's publishing this garbage and putting it out there. It was 22 pages with like 11 to 16 pages with all these charts of these ridiculous returns that not one trade was ever done in real life. Well, Kevin, you've worked for some educations. I have. Options Animals, not bad. Safe Option Strategies is excellent. I know a couple do a couple actual trades. What used to piss off these educations is I would do all my trades real. And that bothered other coaches because they couldn't, they didn't have any money. There's these expert market traders that could make you millions, but they didn't have a damn penny in the market. It used to piss educations off that I would actually show real trades, that I had real accounts, real positions in mind here. For those of you that I know have been in education, there's no reason to waste your money on anything that's been published. There's no reason to waste your money on anything that's in education. You probably already know enough. And there's, again, nothing that's truly out there that's doing these trades in real life. If they were, they would be showing you their live account every single time. A couple of you asked for some leap long calls on a couple other positions. So let me get to that really quickly. I think we had Walmart, Merck, and Boeing. So let's take a quick look at those positions for leaps. Anytime you get these drops in the market, probably going to be a buying opportunity in some way, shape, or form. If we're looking for a leap position, Walmart right now is trading at 134.35. I would probably be going out to January 23. I'd probably be going out to the 135 strike price. $16. $16.82. Let's see here. 1682. So we're going to take 1682, divide it by 134.35. This only is 12.51% of the value of the stock, which would mean you have what? 87.49% of the position that's not at risk. 87, if I do my math right, 87.49% of the value of the stock you are not putting at risk, because we are we're not putting that much money in. Walmart has some growth opportunities in it. It's a great position to be in. If I was to look at Boeing, who used to trade up to 400, add an option, one call, January 23, trading at 240, maybe just a little bit, go up 245, $54.50. If you do the math, you take $54.50, divide it by 240.68. This one's a little more expensive. This one is 22.64% of the value of the stock, which means you are hedging 77.36. You're taking 77.36% of the risk out of the stock by owning a leap long call. I usually wouldn't do Merck in this. I believe that's MRK, right? I usually stay away from a company like these guys, only because medical, pharmaceutical, those type of companies have inherently higher risk in their positions. 76, see if they got a 77.50 in here. $8. 8.05 divided by 76.34. This is more like Walmart. So everything I just told you is not true. It's only 10.54% of the cost of buying the stock, which really means this is 89.46%. You're hedged out 89.46% of the risk of owning the stock. Now, there are some issues. You don't get paid dividends on longs. You like some dividends, you want to be in the stock ownership. If you want dollar for dollar movement on your stock versus 50 cents on the dollar until it grows, you have to wait. but this takes out a lot of the volatile risks that we're seeing in the stock market right now. And that's why we do those leaps, unless the feed is not running correctly for your broker. And the feed was not running correctly for Interactive Brokers either. I checked with Money Block, but they couldn't get back to me on it. So, any questions that I can answer for you? Any questions that you guys have that I can get answered for you? Let me give you guys 30 seconds to make sure you don't have a question. If not, guys, I appreciate you guys being with me tonight. I hope this is helpful, showing you the problems with what's out there and some of the garbage that's out there. Rich, hopefully this is answering your question on Baidu. I got your message. I was just busy this afternoon. So I want to make sure that we get all these answered. If the leaves go down, would you dollar cost average them? Maud, that's exactly what I would do. So when we get called out on a caller trade and we book a 15, 20, 25% profit, I only start using about a third of that profit. Knowing I may dollar cost average one or two more times, the key is to limit how many times you dollar cost average, because you don't want to throw good money at bad. So rule of thumb, take a third of your profits, put it in. Know the second time you do it might only be worth, 17% of those profits. I usually don't dollar cost average until the long position has lost half its value. That way, a 50% loss only needs a 25% run back up to break even if I set these levels to dollar cost average. I might do it a second time, knowing it's quite a bit cheaper. What I'm really trying to do is protect 40 to 50% of your profits and not, for lack of a better term, waste them or dollar cost average away your profits from your original position. So that's why I run things the way I do. Lee, the one thing that Apple was pretty reliable, made a lot of money. Now it seems more a question. Do you think this is just a temporary thing? So Apple right now has gone through a stock split and it's diluted its shares. It actually has so many billions and billions and billions of shares that it doesn't have the movement that it used to have when a hedge fund would come in and a Warren Buffett would come in and buy it up. It has too many shares to get those type of movements like it once did back in the days when we traded it 10, 12, 14 years ago. So Apple is becoming a commodity type stock. It probably will not see its big runs. It hasn't had a good intervention for quite a while. That's not what I'm saying. An intervention has not come up with a new product, an invention that has really made a difference or moved the needle. They're getting tens of billions of dollars through services, but it's not enough to move a company that has over $1 trillion market cap. So the short answer is the law of large numbers has caught up with Apple. That's why around that 150 we'll just be shaving positions off unless Apple does a better job of buying back their stocks. What is another stock that you might consider now like Apple was 10 years ago? So NVIDIA is an opportunity, but it's rather pricey until it goes through a stock split. Micron seems like it has an opportunity to really move. I think Baidu is still the next Apple type position. I'm not sure when you're looking at technology because so much is software based. A lot of people like software based companies, especially for protection on the internet and so forth. But that's a cycle or two away from becoming irrelevant. So I'm not a big fan of some of these virus protection companies, these hardware protection companies. Again, it's just a software cycle or two away from being irrelevant. So I'm not much of a software player. I'm not sure what the new technology is. I'm a pretty logical kind of guy. So I don't use new technology as a I don't use new technology as a how would I say it? I'm not smart enough to know what the new technology is going to be that'll make millions of dollars like Apple. Abraham asked about Microsoft. I really think Microsoft is old news. All they have is the cloud. You know, they're doing some of these team sessions, but there's nothing that's truly innovative about their software. They're just trying to copy other products that's already out there. So I would not consider Microsoft a good buy. As you run their valuation numbers and so forth, there's really not a chance that Microsoft will double in the next 2 years or more for that matter. All right, guys. Hey, appreciate your time tonight. I have got to run. I will get this up sometime tomorrow. I do hope this was helpful. I do hope you enjoyed seeing a little bit of what I look at day in and day out, some of the frustrations with live feeds, advertising for other companies that are out there, and a little insight into what we're doing with these leap long calls and how I'm justifying or telling you that they are less risk than stock ownership. Have a good evening. Appreciate your time, and I look forward to seeing you on Thursday morning. Bye-bye.